Two guys, same age, same city, same $65,000 in the bank, same $75,000 salary. One signs a purchase agreement on a house. The other calls his landlord and renews his lease for another year. 20 years later, one of them sits in a home he owns outright, worth over $600,000, with a monthly housing cost that is actually lower than it was on day one. The other one has an investment portfolio that surprises everyone who assumed he was throwing money away on rent, including himself. Here's the problem with every rent versus buy debate you have ever watched. The buying side leads with the ending. They show you what a house is worth in 20 years and call it proof. The renting side leads with words like freedom and flexibility, and quietly pretends those words have no long-term financial cost. Neither side runs the complete math. Neither side puts everything on the table. This video puts everything on the table. The closing costs that show up at the signing table, not in the listing brochure. The mortgage interest that swallows most of year one before a single dollar goes toward equity. The property taxes that climb every time the home appreciates. The maintenance budget that never once appears on a real estate influencer's thumbnail. And the number that almost never gets calculated honestly, which is what actually happens when the renter takes every dollar he is not spending on a mortgage and puts it into the market every single month for 20 years. By the end of this video, you will know the real break-even point between buying and renting in a realistic market, why the phrase "throwing money away on rent" is more misleading than it is math, and exactly which situation makes buying the clear winner versus renting the smarter play. Before we get into the numbers, if this kind of complete and honest breakdown is what you have been looking for, subscribe right now. This channel runs the real math on financial decisions, not the version that sounds good on a thumbnail, but the version that actually holds up in a spreadsheet. Subscribe and turn on notifications so you never miss one. Jake and Marcus are both 32 years old. They both earn $75,000 a year. They both have $65,000 saved up. They are renting in the same mid-sized city where a comfortable 3-bedroom home in a decent neighborhood is listed at $340,000. Jake decides to buy it. He puts $65,000 down, which comes in just under 20%, and he takes a 30-year mortgage at a 7% interest rate. His principal and interest payment comes out to $1,840 per month. On top of that, he pays property taxes of $340 per month, homeowner's insurance of $140 per month, and he sets aside $280 per month for maintenance, which is roughly 1% of the home value annually, and the minimum any honest financial planner will tell you to budget. Jake's total monthly cost to own this home is $2,600. Marcus looks at the same numbers and calls his landlord. He rents a nearly identical 3-bedroom in the same area for $1,950 per month. He takes the $65,000 he did not spend on a down payment and puts it into a total stock market index fund the same week Jake closes on his house. He also commits to investing the $650 monthly difference between what Jake pays and what he pays every single month going forward. On paper, Marcus looks like he found the loophole. He's living in a nearly identical home for $650 less per month, and his capital is still working in the market. Now, here's the thing almost nobody says out loud in this debate. The moment Jake signs at closing, he's not ahead, he's behind, and not by a little. Closing costs on a $340,000 home run between 2 and 5% of the purchase price. Lender fees, title insurance, attorney fees, prepaid taxes, escrow setup. Jake put $65,000 down to get into this home, but his real day one cost is closer to $77,000 to $84,000. That gap has to be recovered before buying starts making more financial sense than renting. The real estate industry doesn't advertise this number because it makes the first year look bad, but it's real, it's standard, and it comes due at the closing table. This is where the rent versus buy debate almost always goes wrong. The home ownership side talks about building equity from day one. What they don't mention is that in year one of a 30-year mortgage at 7%, the vast majority of your payment is interest, not equity. Of that $1,840 monthly payment, roughly $1,600 goes to the lender as interest in month one. Only $240 goes toward actually reducing the loan balance. Jake is paying $1,600 in interest, $340 in taxes, $140 in insurance, and $280 in maintenance. That is $2,360 per month going out the door with zero equity attached to it. The $240 in principal paydown is the only part of his monthly payment doing what people imagine the whole payment is doing. The phrase, throwing money away on rent, survives because it sounds true. But in year one, Jake is throwing away $2,360 per month on costs that build no equity at all. Marcus is throwing away $1,950 per month on rent. Marcus is throwing away less. Now let's run the actual numbers through year 3, because this is where the fantasy starts meeting the spreadsheet. Over 3 years, Jake has paid approximately $93,000 in total housing costs, principal, interest, taxes, insurance, and maintenance combined. Of that, roughly $8,000 has gone toward actual principal paydown. His remaining mortgage balance is approximately $262,000. If the home has appreciated at 3 to 4% annually, it is now worth between $372,000 and $385,000. His equity sits somewhere between $110,000 and $123,000. That is real wealth. It is also locked inside the walls of a house he cannot sell without paying 5 to 6% in commissions on the way out. Over the same 3 years, Marcus has paid $70,200 in rent. His $65,000 index fund investment has grown to approximately $86,000 at historical market returns. His $650 monthly contributions have added another $26,000 in portfolio value. Marcus's total invested wealth is approximately $112,000. He has not replaced a water heater. He has not dealt with a roof leak. He called his landlord. At year 3, Marcus is slightly ahead in liquid net worth. Jake has more equity on paper, but Jake cannot spend equity without selling the house or taking on new debt. Marcus can access his portfolio any business day. If this breakdown is already showing you the parts of this debate that usually get skipped, go ahead and hit like on this video. It takes 1 second and it helps more people find this content. Back to the numbers. Now let's talk about the costs that almost never make it into the buying analysis. Transaction costs on the back end. When Jake eventually sells this house, he will pay a seller's commission, typically 5 to 6% of the sale price. On a $500,000 home, that is $25,000 to $30,000 leaving his pocket at the closing table. Combined with what he paid going in, his total transaction drag over a full buy and sell cycle is often 8 to 10% of the home's value. That is the hurdle appreciation has to clear before the investment actually performs. Property taxes grow with assessed value. Jake's $340 monthly tax bill is based on a $340,000 home. If that home appreciates to $500,000 in 15 years, his taxes will follow. In many markets, that means his total monthly housing cost rises over time, even though his mortgage payment stays fixed. Marcus's rent will also increase, but his landlord absorbs the property tax exposure, not him. Maintenance is not optional, and it is not always $280 per month. Budget years look like $150 in caulk and light bulbs. Reality years look like $9,000 roofs, $7,500 HVAC systems, and $4,000 foundation repairs. These costs are guaranteed over a long enough timeline. A homeowner who does not set aside for them is not saving money. They are borrowing time against a bill with a due date that never gets announced. Opportunity cost is the number that almost never appears in home ownership calculations. Jake's $65,000 down payment is gone from the market the moment he wires it to closing. At a 10% average annual return over 20 years, that $65,000 would have grown to approximately $437,000 in a total market index fund. That is not money Jake lost. It is the alternative outcome he traded for home equity. The comparison is only honest if you count both sides. We are about to get to the year 10 and year 20 numbers, and this is where the story shifts in ways that genuinely surprise people on both sides of this debate. Make sure you are subscribed so you catch the follow-up video where we model exactly what these numbers look like when you combine both strategies. Subscribe and let's keep going. By year 10, Jake's home is worth approximately $470,000 to $490,000 at 3 to 4% annual appreciation. His remaining mortgage balance after 10 years of payments is approximately $238,000. His equity sits between $232,000 and $252,000. He has spent roughly $30,000 to $40,000 on maintenance, repairs, and small upgrades over the decade. Total money out of pocket over 10 years, down payment, closing costs, and everything above principal is somewhere between $155,000 and $180,000. Marcus has been investing since day one. His original $65,000 has grown to approximately $168,000. His monthly contributions averaged roughly $570 per month over those 10 years because, as his rent increased at 3% annually, the gap between his costs and Jake's costs narrowed. His contribution-based portfolio growth adds approximately $105,000. Marcus's total liquid portfolio at year 10 is approximately $273,000. On liquid net worth, Marcus is still ahead. Jake's equity of roughly $240,000 trails Marcus's $273,000 in invested assets. But something important has shifted. Marcus's rent by year 10 has climbed to approximately $2,620 per month. He is now paying nearly as much as Jake every month with nothing building underneath it. And Jake's mortgage payment is fixed for 20 more years. Marcus's rent will keep climbing. By year 20, Jake's home is worth approximately $650,000 to $680,000. His mortgage balance has dropped to around $182,000. His equity is approximately $468,000 to $498,000. He has spent somewhere between $55,000 and $75,000 total on maintenance over the 2 decades. His monthly housing cost has stayed anchored to that original $1,840 payment, even as everything around him has gotten more expensive. Marcus's portfolio at year 20 is approximately $530,000 to $560,000, assuming he held through every market correction without selling and kept contributing even as his rent absorbed more of his income. His rent by year 20 has climbed to roughly $3,500 per month. In the later years of this comparison, his monthly investment contributions have shrunk because the comp advantage he started with is almost entirely gone. The compounding that powered his early years is now partially offset by a rent bill that has no endpoint. At year 20, Jake has approximately $470,000 to $500,000 in home equity. Marcus has approximately $530,000 to $560,000 in liquid assets. Marcus is slightly ahead on total net worth, but Jake has something Marcus does not. In 10 years, Jake's mortgage ends. At year 30, he owns a home outright worth $850,000 to $950,000, and his monthly housing cost drops to taxes, insurance, and maintenance, roughly $900 to $1,100 per month. Marcus at year 30 is still paying rent, which by then has climbed to $4,700 to $5,000 per month. No asset, no endpoint, no floor under his cost of living. Now here is the part that changes the renting math more than anything else. The renter and investor strategy works and works extremely well if you actually invest every single month, including the months when the market drops 30% and every instinct you have says wait it out in cash. Every analysis that shows renting outperforming buying is built on the assumption that the renter invests every dollar of the cost gap with perfect consistency. The data on whether actual renters do this is not encouraging. Most people spend the difference. They upgrade their lifestyle. They move into a nicer apartment because they can. When the number in their bank account grows, they find a way to spend it. The buying strategy enforces savings automatically through the mortgage payment every single month. That forced discipline is worth something no spreadsheet captures, and it is the primary reason home ownership produces more wealth for average people than the theoretical numbers would predict. Now, let's be equally honest about the buying side, because the people who skip this part are the ones selling you the rosy version. The break-even timeline is longer than most buyers expect. When you factor in closing costs going in, selling costs going out, and the interest-heavy early years of the mortgage, buying a home typically does not start outperforming renting and investing until year 5 to 7 in a normal market. Buy a house and sell it in 3 years, and there's a very real chance you lost money compared to renting. Mobility has a price, and home ownership makes mobility expensive. Concentration risk is real and underappreciated. A homeowner in a market that stagnates or declines knows what it feels like when your largest asset drops 30% and you cannot simply rebalance. Marcus is diversified across thousands of companies in dozens of sectors. Jake's entire net worth is concentrated in one building, on one street, in one zip code. Liquidity matters more than people realize until they need it. Jake cannot sell 5% of his house to cover a medical emergency. He cannot tap his equity without taking on more debt at a new interest rate. Home equity is wealth you cannot easily access, and the process of accessing it always costs money. If you're finding this more useful than the version that simply tells you to buy or simply tells you to rent, go ahead and hit like on this video right now. It takes 1 second and it helps this content reach more people. And subscribe if you have not already. Here is the honest answer, and it is not the same answer for everyone. Buying wins clearly in specific situations. If you're planning to stay in one place for at least 7 to 10 years, the transaction costs stop being a drag, and the fixed payment becomes a massive long-term advantage. If your local price-to-rent ratio, which is the home price divided by the annual rent for a comparable property, is below 20, buying tends to pencil out in your favor. If your rent is already close to what a total mortgage payment would cost, the financial argument for renting weakens every single year. And if your market consistently appreciates above the national average, the leverage built into a mortgage accelerates wealth faster than any equivalent portfolio position can match. Renting wins clearly in other situations. If you might move in the next 3 to 5 years, the transaction costs alone will likely leave you behind. If your local price-to-rent ratio is above 25, renting and consistently investing the difference will often outperform buying even over long time horizons. If you are in a career phase where mobility creates meaningful income growth, the flexibility of renting has real economic value that does not appear on any spreadsheet. And if you can genuinely maintain the investment discipline the renting strategy requires, buying every month, holding through every crash, never touching it, the math supports you. Here is the question that changes everything in this analysis. What if you did not have to choose? What if you bought a duplex, lived in one unit, rented the other, and let your tenants cover most of the mortgage while you kept investing? The math on combining both strategies is a completely different conversation, and the numbers in that scenario change almost everything we looked at today. But before you go anywhere, the most important question you can ask in this decision is not which one wins on average. It's 2 questions. How long are you actually planning to stay? And if you rent, are you honestly going to invest the difference? Because everything else flows from those 2 answers. The math, the comparison, the year 20 outcome, all of it depends on what you actually do, not what you plan to do. And that's the only version of this analysis that actually matters. If this video gave you a clearer picture of what renting versus buying actually looks like when you run the full numbers, not just the equity part, not just the flexibility part, but all of it, please hit like before you go. It genuinely helps this content reach more people. Subscribe for weekly videos that break down financial decisions completely, honestly, with real math and no agenda. And drop a comment below. Are you team rent, team buy, or somewhere in the middle? I read every single one.